Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'd like to share with you some of the ideas that I passed along to my paid subscribers this past weekend in my weekly newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. The leading article of last weekend's newsletter was titled, Is This It? On September 19th, the much maligned Robert Prechter declared to his subscribers, of which I am one, "This is it." By that he meant this is the top in the stock market for our lifetime. Yes, for our lifetime. Not just a short-term move here, but a very major move. Now, given the turn in the market this week, Prechter's call of a top on September 19th does appear increasingly prescient. I sent an email to my good friend Ian Gordon this past week to ask him if he thinks we have now seen a generational peak in the stock market. And Ian was very certain that that is the case. By the way, Ian appeared on my October 2009 show, that's October 20th, 2009, along with Robert Prechter. And on that show, Prechter predicted a sub 1,000 Dow, I think his numbers are closer to 600 on the Dow, and lower gold prices from that period. And Gordon predicted a 1,000 Dow and a $4,000 gold price. And you can listen to that interview if you go to the Voice America Business Channel. Look for my page, Jay Taylor, or Turning Hard Times into Good Times, at the Voice America Business Channel. Well, although Prechter has been steadfastly, and I might add wrongly, bearish about gold since then, I think he is much more reasonable about gold than most gold bugs think he is. Prechter believes that gold will rise vis-a-vis almost everything else except the dollar. He is indeed an extreme deflationist. The differences between Prechter and Gordon is that Prechter believes the dollar will prevail, while Gordon believes it will suffer the same fate as all other fiat currencies in history have suffered. In other words, the dollar will become worthless, and hence gold will rise to enormous levels denominated in that worthless currency. Well, what is there evidence of deflation out there? Can there be any doubt? In my mind, there is no doubt that if central banks everywhere stopped printing massive amounts of money, we would enter a deflationary depression that would cause the 1930s to look like child's play. Of course, given the massive debt built up over many decades, the Fed is quite rightly fighting deflation tooth and nail, and from their perspective, they are right to do so. I completely understand their short-term fears. But of course, the Fed never should have been born in the first place, and we never should have left honest money in the form of gold or silver. If we had stayed with an honest monetary system, we would not be on the precipice of a financial disaster that we're on. But is there any concern for deflation, really? Honestly? Come on, Taylor, you know there's been trillions of dollars of money printed, money created. How can you possibly think that we face deflation? How can you possibly agree with the Federal Reserve Bank, the Federal Reserve's concerns? You say that you understand and agree with it. Well, let me answer that question. First of all, consider the fact that money is created with debt. Debt is the raw material from which money is created. And so as the Fed quote-unquote prints money, it is really creating debt. And if you look at any chart of recent times, you'll notice that debt is growing almost exponentially, whereas income in the economy, as measured by GDP, is growing in a very slow linear manner. And so the gap between the amount of cash flow to service that debt is growing ever larger. So I would argue that the economy as a whole is becoming more and more deflationary rather than inflationary. Now, if you actually helicoptered money out, printed money without debt, just printed pieces of paper, and floated them over the country, then I agree that you could have hyperinflation. And I'm not saying that that isn't a possible outcome anyway, as Congressman Paul has argued on this show in the past, that the Fed can simply send out electronic transfers to the millions of voters throughout the country. And indeed, that is a possibility. But they're not doing that so far. All they've done so far is bailed out their banks. They've printed huge amounts of money, put it into the monetary system, and it's sitting largely undistributed. It's sitting in banks where that money is available to certain privileged characters that have access to it for hedge funds and the like. It's there for speculation and for casino gambling. But for the most part, we have this huge and growing debt enormous amount of debt that is, I think, making it impossible for the economy to grow. I think it's very interesting that, in fact, we actually did have deflation briefly, if you define deflation by a collapse in prices, immediately after the Lehman Brothers debacle. And then the Fed was able to catch that falling knife by printing huge amounts of money, stimulating the economy, and in the short run, increasing demand and avoiding and keeping prices from falling any further. The problem again is that that money was created by debt, and debt is growing much more rapidly than income. So yes, I think that deflation is a real concern of the Fed, and there's a whole lot of other reasons why the economy can't grow, because money pumped into the system creates malinvestment, and so we're stuck with a very slow, if there's any growth at all, and by the way, I don't believe there is. I believe John Williams' inflation numbers are much higher than what the government lets on they are. So I'm not arguing that we have deflation now. I'm arguing that we have inflation, and we have more than the government suggests we have. And if you factor that rising inflation, or that increase, that higher than stated inflation, then and you factor that into GDP, then we have actually negative GDP. I think John Williams is absolutely right about that. So we have negative economic growth, but we have rising prices, certainly for health care, education, all kinds of things that you can't import into the United States is growing very, very rapidly. So we do have a problem with inflation. I'm not saying that we don't. In fact, the rising cost of living for the middle class is one of the issues that is, in fact, creating deflationary pressures. On top of huge debt, servicing requirements, and wages that have not kept up even with the government's fraudulent inflation accounting numbers, the middle class is finding that its consumable income is decreasing very dramatically as it spends everything it earns basically on food, clothing, and shelter. So it has very little disposable income, and hence there's less and less demand for various production in the United States economy. Indeed, a very interesting insight came from James Turk this past week, who talked about the Indiana toll road going bankrupt essentially because Americans are driving less. This isn't just in Indiana. This is a countrywide issue. As gasoline consumption has decreased, so has traveling decreased very dramatically. It means that toll roads are not receiving the income, and in fact, the Indiana toll road is not receiving the kind of income it anticipated. Hence, it has insufficient funds to service the debt that is underneath that company's balance sheet. So this is symptomatic of a struggling economy, which signifies, in my view, deflation, not inflation. Yeah, there's cost of living is rising, essentially taking away the disposable income of individuals en masse. Salaries are not keeping up either with that rising cost, so the disposable income and the ability to consume is being decreased for most Americans. Which brings me to the stock market analysis of Dr. Robert McHugh. Now recall the comments I made just a few minutes ago from Robert Prechter and Ian Gordon. And remember, Prechter is talking about a 1,000, actually a sub 1,000 Dow and lower gold prices, and Gordon is sticking with his 1,000 Dow and a $4,000 gold price. Well, Dr. McHugh, who, like Prechter, is an Elliott wave analyst, thinks we are heading for a massive stock market crash that he believes will trigger what he has called in his book, The Coming Economic Ice Age. He's termed it a cataclysmic nation-changing event. I'm actually going to be interviewing Dr. McHugh on Wednesday, that is tomorrow, and that interview will be posted at J. Taylor Media on Wednesday morning. So I hope that you'll tune in and listen to what Dr. McHugh has to say. But let me read just a few of the most recent comments from Robert McHugh. He believes that this recent weakness in the equity markets may well be the start of a massive decline in stocks, which will, over the next couple of years, make the 1930s stock market decline look like child's play. I hope he's wrong, but here are some of the quotes from Dr. McHugh that he passed along to his subscribers as of the end of this past week, that is, as of Friday, October 10th. And I quote, "The stock market just had its worst week since May 2012. The industrials are now at a loss for the year 2014. We have been showing a multi-decade jaws of death stock market pattern for several years now, warning that when it finishes, a massive bear market and economic collapse will begin and last for many years. I even wrote a book about the pattern's clear warning it is very possible that the time has arrived when the pattern is finished and the next bear market and economic collapse has begun. We are now on high alert. Bids are hard to come by right now in the stock market, and our analytic work suggests that the secret plunge protection team activity is providing at least half of the bids in the stock market. Prices keep falling, but the descent is slowed by the plunge protection team's buying, providing a safety net under the stock market. However, this market continues to look heavy, and there are limits to what the plunge protection team can buy. At several points over the next 7 years, we expect the stock market to experience crashes. Some will be minor, some huge. At this phase of the new bear market, many advisors are labeling this decline from September 19th as a buying opportunity. Believe me, that sentiment will change down the road. So far, the industrials have lost about 800 points off their all-time highs a month ago. The S&P 500 has lost about 120 points. When I study the stock market's price wave labeling and pattern this weekend, I am hard-pressed to see a complete 3-wave or 5-wave decline from September 19th. In other words, what Dr. McHugh is saying is that he does not believe that this recent decline is anywhere near the end. And then he goes on to talk about his charts on pages 36, 37, 39, and 41. He says, in fact, the charts on those pages are looking for a wave 3 decline in 5 degrees of trend now. Since wave 3s are the most dramatic, this means the stock market right now is in imminent danger of a mini crash. It will be interesting to see if the plunge protection team is all over this risk and comes in Monday morning guns a-blazing with heavy buying to try and prevent what charts suggest is likely this week. Well, let me just parenthetically note that the plunge protection team did come in on Monday. It tried to keep the equity markets from declining. We saw a brief increase in equity prices. And then as the day wore on, which has become so typical, we saw a massive decline in the stock market. So that on Monday, the prices were much lower than they were on Friday when Robert McHugh was making these comments. And now let me continue with Dr. McHugh. He said the powerful end of day sell-off Friday had the feel of a wave 3 move. The industrials closed below their 200-day moving average Friday. The S&P 500 came within a whisker of its 200-day moving average, less than 1 point, which may consider key support. Both the S&P 500 and NDX, that is the NASDAQ, have dropped decisively below the bottom boundary of rising bearish wedge termination top patterns from October 2013, which is very bearish. Downside price targets are provided by these patterns. They're beginning. Those levels are substantially below current price levels of 14,750 for the industrials, 1665 for the S&P 500, and 2800 for the NASDAQ. These downside price targets do not have to be reached during the first decline into November 20th, 2014 bottom. It may take a year to get there, with several ups and downs, stair-step moves to reach those downside levels. Those are not the ultimate downside price targets for this huge grand supercycle degree wave 4 move. The jaws of death pattern suggests 70% or more of the stock market's values could eventually be lost as this economic collapse proceeds to its conclusion many years from now. The next FIMATE turn date is October 27th and is a major turn date. The next Bradley model turn date is October 16th and is a minor turn date. The next major Bradley model turn date is November 20th. These turn dates could possibly mark the bottom for wave 3, the top for wave 4 up, and then wave 5 down of the first large leg of the next bear market that started on September 19th. And so I might just parenthetically add that September 19th is seen, just as Robert McHugh agrees with Prechter, that is the top of the market. That will be the top of this equity bull market, September 19th. Continuing on with Dr. McHugh, it is possible stocks decline into November 20th then rally into early 2015, correcting the decline from September 19th, 2014. To keep things in big picture perspective, I show a long-term chart for the industrials with wave labelings from 1900 through 2014 on page 30 of my most recent report. The grand supercycle bull market from 1718, yes, that's 1718, before the United States was born, has encompassed all of the rise in prices over the last century shown on this chart. This is ending now. Incredible. If we look at what is happening in the world right now, we can see that there are major paradigm shifts occurring, world-shaking events perhaps in their infancy. The ISIS abomination is reminiscent of the rise of the Nazis in the late 1920s and 1930s. The Nazis seemed to come out of nowhere. The world sat back and watched, not wanting to get involved, while the Nazis annexed nations and slaughtered innocents until it became essential to stop them. Same thing is occurring now with ISIS. They are making progress towards a takeover of two countries, Iraq and Syria. Turkey could be targeted next. Iran is close to having nukes. It does not take a rocket scientist to see that the Middle East is about to explode. It will eventually result in a war with Israel, and the Islamic militants set their sights on Israel and draw in all the nations of the world. This will result in economic collapse worldwide, the fulfillment of the jaws of death pattern we have been monitoring. We are watching the seeding of World War III. As my book noted, major wars have accompanied each jaws of death pattern we saw over the past century. There will be a war with this multi-decade jaws of death pattern, the largest such pattern by far as well. We will need God to intervene to stop the coming insanity. On Friday, demand power fell 4 points, while supply pressure rose 8 points, telling us that the decline was strong and that deep pockets stepped into the unbalanced orders. Deep pockets meaning, of course, the plunge protection team of the government, which prints money out of nothing to buy these stocks. And that made the market and kept a collapse from occurring. The damage was bad enough in spite of the deep pockets intervention. Is the bottom near? Not at these levels. Maybe for a short bounce, but probably not yet at these levels. We say that tonight because none of the key indicators we watch suggest that selling capitulation has occurred and a significant bottom has arrived. Oversold new lows, an oversold 10-day average advanced decline line indicator, and other measures typically seen at selling capitulation are not present at this time. Therefore, patterns aside, more downside is likely. If we want a sliver of a silver lining, we are starting to see some small bullish divergences in some of our indicators, which means that once they mature in size, a bottom will arrive. That may be a few weeks away, however. The rally they forecast will likely start from much lower price levels and be a corrective bounce, not a new bull market run. Techs and trannies got hammered on Friday, October 10th. Volume was high again. Our short-term key trend finder indicators for both blue chips and techs remain on a sell signal this weekend. Our intermediate-term secondary trend indicator also remains on a sell signal tonight. Batten down the hatches. The stock market remains on a confirmed and official Hindenburg omen from Friday, September 19th. This comes at the precise same time that a rare and important and dangerous bearish divergence is occurring between the New York Stock Exchange cumulative advanced decline line and stocks, and also is coming at the same time the long developing multi-decade extremely dangerous bearish jaws of death pattern looks complete. It also comes when the Fed will now be pulling liquidity out of the market. This confluence is very dangerous, and it is arriving at the seasonally worst time of the year for stocks, the September and October time frame. End of quote. Dr. McHugh also opines on gold, and unlike his fellow Elliott Wave analyst Robert Prechter, Dr. McHugh is very bullish on gold. Again, let me reiterate, though, however, that I see Robert Prechter as being mildly bullish on gold, even though he's talking about lower nominal prices for gold. I say that because in Prechter's view, gold will rise versus almost everything else except the dollar. I don't agree with Prechter. Gordon doesn't agree with Prechter. McHugh doesn't agree with Prechter. Most people don't agree with Prechter because history shows that paper currencies, fiat monies, ultimately are totally destroyed. And I can't help but believe sooner or later that will happen to the dollar. Of course, what is happening now, the senior currency, as Bob Hoy points out, the senior currency in one of these major credit contractions always is the strongest currency. Why is that? It's because the dollar has more debt than any other currency, and that means that it is the largest short play. It is the largest short position, and so when the credit clerks start calling in their loans, more assets have to be sold in exchange for dollars, so the value of dollars are bid up as people sell their assets and exchange them for dollars. So the demand for dollars grow as the senior currency declines. So the senior currency can be the stronger currency of all currencies. However, that leads me to the point of why gold will be the last asset to really appreciate in value. If we look at the work of John Exter created this image of an upside down pyramid, an inverted pyramid if you will, in which items that during the boom time are most in demand and bring the highest dollar values. Items that are very speculative, luxury items, items at the top, and when times are good, people are buying second and third homes, they're buying boats, they're buying second and third cars, they're doing all kinds of things. Companies are becoming not concerned about risk, and so they're just really becoming very reckless and speculating. Investors speculate, companies speculate. There's no fear of default because times are good, and that's what happens in a boom period. But when the opposite occurs, the items that are most conservative, least interesting during the fun times, now become the most essential. And so in Exter's inverted pyramid, he has at the top items like small businesses, real estate, diamonds and gemstones, over-the-counter stocks, and then down the line, less risky but still quite risky, commodities, municipal bonds, and then continuing down, corporate bonds, listed stocks, government bonds, continuing down, less risky but more boring, treasury bills, Federal Reserve notes, that's the money you carry in your pockets, and last but not least, the most boring of all things during the good times is gold. Well, what happens when the system goes into reverse? All the items at the top that were the fun items, the items of speculation and getting rich quick and enjoying the sensual things in life, are thrown out the door by necessity. And people, just as the American consumer now, is having to focus more and more on his essential consumptions and doing away with the frills. That is what happens when an economy starts to deflate or starts to contract because of the excessive amounts of debt. And I think that is very much what's going on right now. And of course, we're seeing stocks start to decline very dramatically. Stocks had gotten very overpriced. And that's a whole other discussion as to why I believe that is true. There's clearly the mainstream are arguing that stocks are still reasonably priced. I don't buy that for a minute for a host of reasons that we don't have time to go into right now. But if you accept my notion that stocks were at least fully valued, if not overvalued, and now we have this enormous amount of indebtedness, now people have to start selling what they're able to sell to make sure they pay their loans so they can keep the roof over their head and food on their tables. Essentially, that's what it boils down to in plain terms. So what happens is, from the least liquid, most speculative items to the most liquid, least speculative items, and at the bottom of Exter's pyramid is gold. Right above that, Federal Reserve notes. So what we're seeing happen now is what happens when people sell things and they become risk averse. They buy U.S. Treasuries and U.S. dollars. So that's to be expected. It's not surprising that the U.S. dollar has been stronger recently relative to other currencies and relative to gold too. Robert Prechter expects that trend to continue on forever until the dollar becomes extremely strong and everybody wants to hold paper dollars. Well, if you buy that, then that's fine. Prechter still at the same time believes that gold will buy more of everything except the dollar. But I believe that the most likely outcome is what has happened through history, and that fiat money becomes totally destroyed. And in that event, we know from history that people turn to asset-based money as opposed to liability-based money, which is what fiat money, our fiat money system, is created. As I noted earlier, debt is the raw material from which money, fiat money, is created. Not so with gold and silver, which is an asset-based money. That is produced through the sweat and capital of the investors out of the ground, and asset-based money is what we really should never have departed from. But human beings are weak. They want to have something for nothing, and paper money seemed to provide that for the longest time. Still, the Federal Reserve is betting that the PhD standard is better than the gold standard. They are going to be disappointed. We are on the verge of something, I think, to use Dr. Robert McHugh's words, a cataclysmic, nation-changing event. And the Western world, which has betted its bottom dollar, literally and figuratively, on paper money, is going to go through some extremely difficult times, I'm afraid. It's certainly not what I want to see happen, but it's what I believe is in the process of taking place. I think we're at the very early stages of that. Whether we see that the equity markets are now going to head down, and this is, I think, most likely, Prechter and McHugh are right, that the 19th of September will mark the highs of this bull market in equities. Whether or not that's true remains to be seen, for sure. But the handwriting is on the wall as far as I'm concerned. We're heading for some very, very difficult times. And it is those difficult times that we need to think in terms of the reality of markets, the reality of the world we live in. And that reality suggests that you stay out of debt and you buy money that is time-revered money, money that isn't based on somebody else's ability to repay their debts, but money that actually has intrinsic value locked into it. And that money is gold and silver. Now, at some point here, and I think we're very, very close, we're going to see the gold price bottom out. In fact, I think there's a very good chance both Charles Nanner and Dr. Robert McHugh and others seem to be of growing opinion that we probably have, or may very well have, seen the bottom in the gold price. Already we're starting to see some strength in the junior gold mining companies, and I'm very encouraged by what I'm seeing among the junior gold mining companies. I think that we are looking at some of the most outstanding potential upside that I have seen in my lifetime in the gold mining sector. It is the most maligned sector in the stock market, and while everybody has been laughing at gold and gold shares, I think the old saying that he who laughs last laughs best is certainly going to be played out in the near future. They've been battered down so hard, and of course we heard earlier today from Rick Rule and the Sprott boys in terms of their gold fund. I would suggest that you consider an ETF, a gold fund of some kind or another. The Tocqueville fund is one of my favorites. And if you are interested in buying individual stocks, I hope you'll consider subscribing to my newsletter, J. Taylor's Gold, Energy, and Tech Stocks, because I have some very exciting stories to tell you, some very exciting companies, very undervalued companies, companies that are producing, even at these low gold prices, very solid cash flows. And the list of those companies are going to grow. And I think as they do, I think you're going to see some very, very substantial increases in the share prices of many of the junior gold mining stocks. Well, that's all the time we have for this segment. Thank you for listening. Until next week, goodbye and God's blessings to you.